Credit derivatives are financial instruments that allow parties to manage or transfer the risk of credit-related events, such as a borrower defaulting on a loan or bond. These derivatives derive their value from the creditworthiness of a borrower or financial entity and are primarily used for hedging against credit risk or speculating on changes in credit conditions. The most common types of credit derivatives include credit default swaps, CDS, total return swaps, and credit-linked notes. A credit default swap is essentially an insurance contract on debt. One party, the buyer, pays a regular premium to another party, the seller, in exchange for protection against a specific credit event, such as a bond default or bankruptcy. For example, if a bank holds bonds issued by a company and fears the company might default, the bank can buy a CDS to protect its investment. If the company defaults, the seller of the CDS compensates the bank for its loss. In a total return swap, two parties exchange the total returns of a credit asset, such as a bond, for a fixed or floating rate payment. This allows one party to gain exposure to the asset's performance without owning it, while the other party manages its risk. For instance, a hedge fund might use a total return swap to profit from a bond's performance without directly buying it, while the other party receives steady payments in return. Credit-linked notes, CLNs, are structured debt instruments that combine a regular bond with credit protection. Investors receive higher yields compared to traditional bonds, but they take on the risk of a specified credit event. If the event occurs, the investor may lose part or all of their principal. The primary benefits of credit derivatives include risk management, flexibility, and increased liquidity in credit markets. Banks, for example, use credit derivatives to reduce their exposure to certain loans or bonds, freeing up capital to lend elsewhere. Investors can use these tools to diversify portfolios or speculate on credit risk, taking positions based on their expectations of a company's financial stability or market conditions. However, credit derivatives also carry significant risks. One major risk is counterparty risk, where the other party in the contract may fail to fulfill their obligations. Another is complexity, as some credit derivatives are difficult to value and understand, making them prone to misuse. This complexity was a contributing factor in the 2008 financial crisis, where the misuse of credit default swaps led to massive market instability. For example, during the crisis, institutions sold CDS contracts on mortgage-backed securities without fully accounting for the risks. When defaults on these securities surged, the sellers of CDS struggled to meet their obligations, creating a domino effect of financial failures. This highlighted the need for stricter oversight and transparency in credit derivative markets.